Thanks for joining us today on Market Call. I'm Morella Fernandez. Brian Madden with us on the show, Chief Investment Officer at First Avenue Investment Counsel. He'll take your questions on North American Equities. Here's how to reach us. 1-855-326-6266 if you'd like to call in. You can send your questions to marketcall@bnnbloomberg.ca. Brian, thanks for coming in. Good to see you.
Likewise. Good to be here.
New records for the S&P yesterday, for the NASDAQ, the TSX up again today. Where is all of this optimism coming from? Is it earnings, you think?
A lot of it is definitely stemming from earnings, Morella, but not the entirety of it. I mean, just to set the level, we are in the throes of a barn burner of an earnings season this quarter with, in the States, S&P 500 earnings, the companies that have reported thus far, up 27% year over year, and we're tracking at about the same pace for Canadian companies, although we're less further along in the process as Canadian companies report with a bit of a delay. So there is good fundamental support for higher share prices here. But then the other side of it is twofold. One is there's been a renewed thrust, a surge of interest in all things AI. And so it's really driven a recovery in the share prices of the hyperscalers and the rest of the Magnificent Seven after they sold off pretty sharply in the first quarter and in March in particular. And then finally, of course, the elephant in the room is hopes for peace in the Middle East. And so we're kind of in the eye of the hurricane right now. There's an offer on the table and it's being negotiated. And so the markets are very much, clamoring for that to be a done deal and are pricing a resolution to this conflict, which has choked off global supplies of liquefied natural gas and oil and fertilizers and all kinds of other things for more than 2 months now.
Can I ask where you think energy is going to land if this conflict is resolved soon? I'm asking because, as you mentioned, there's a lot backed up. Energy got such a big boost over the past couple of months from what has been happening. It's down under $100 again today. So clearly people think it's going to be over. Do you think it'll settle back in a range that was above where it began?
Yes. So that's the easy part of the question. But I take your point and, we can talk about the data, the oil prices, liquefied natural gas prices, but data are just the plural of anecdotes. So here's an anecdote just to illustrate the wild volatility. And the reason why this is not just a business news story, but a Main Street story. Yesterday morning, I'm commuting to work. I looked, the gas station near my house, gas is $1.95.7. Coming home, it's $1.83.3. So a 12-cent swing in about 12 hours. So it is crazy, and everyone uses gas to fill their car or to commute in one way or another. And also, let's not forget, energy is implicit in the price of all manufactured goods because they're shipped in some form or another. So, but the easy part of the question is, are oil prices and liquefied natural gas prices going to settle higher than they were pre-war? Almost certainly so, because there is a certain amount of destruction that has occurred in the region, in the Middle East region, that is not going to just come back online overnight. So that's oil export facilities and pipelines and the like. And, there have been strikes at LNG facilities on the other side of the Persian Gulf that reports are indicating will take 3 to 5 years to repair. So there's going to be a long tail to this war in terms of supply chain interruptions for oil, gas, and downstream of them, petrochemicals. So where does that end up? Hard to say, but we were going in the high 50s, low 60s late last year. Right now we're in the low 90s, so somewhere in between there, but probably closer to where we are today than where we were in November or December of last year.
All right, let's take a quick break. We'll line up the first phone calls and emails for Brian Madden, First Avenue Investment Counsel, taking your questions on North American Equities. Here's our contact information. Back in a moment. Welcome back to Market Call. Let's go to an email from Jeff. He says, my question today is on Capital Power. It just had an earnings miss and pulled back. Just curious if you're holding it and do you like it for a long-term hold? So they do power generation. They're out of Edmonton. Pulling up that chart and having a look at where it is today. We talked a little bit about energy. I'm wondering if sort of utilities and energy, what would you do with it today?
Yeah, so this is not a company we own. We did own it in our momentum mandate a number of years back. We've got a better idea in the power generation space, and that would be Vistra Energy, but no real concerns with this one. This probably is a good long-term hold. The genesis of it, and it's really a company that has had quite a transformation over the last decade. It used to be mostly coal-fired electrical power generation in Alberta, but as it exists today, it's still got a big block of business in Alberta. That would be merchant power generation, predominantly natural gas fired with a bit of renewable energy in the mix as well. But half of the business is now in the United States. So they've pivoted away from, let's call it dirty coal, towards cleaner natural gas, and are sort of dripping in some renewable power in the mix as well. It's about a $10 billion market capitalization company, does pay a dividend. The yield is just about 4%, so that's not far off of its long-term historic dividend yield, not far off of the peer group as well. And also, crucially, there's a good cadence of dividend growth here. It's had a 7% compounded annual rate of dividend growth over the last decade. Like all electric power generation utilities, it's re-rated considerably higher in the last few years. It now trades at about 27 times earnings. That's a premium to its historic norm. I think historically it was about 20 or 21. And it trades about 10 times enterprise value to EBITDA, again, also at a premium to its historic average. But all of that, Marilla, is predicated on the fact that it is now, in energy power generation of the future. That's saying nat gas fired rather than coal. And crucially, it's half in a faster and more dynamically growing geography, that being the United States, where, of course, everyone knows the data center build-out is driving a step function increase in power demand. Over the long term, the total compounded shareholder return over the last decade has been a pretty impressive 21%. That's for a utility, which is really quite something. Aspirationally, they are striving to achieve a 13 or 14% compounded total shareholder rate of return between now and the end of this decade. The chart looks pretty good. The management team is pretty good and pretty credible, so no issues with owning this for a long-term hold, although, as I say, we don't own it because we've got another utility we prefer better.
That was an email. Let's move to our first caller on the line. Elliot in Hamilton, Ontario. Elliot, go ahead.
Good afternoon. Arista Networks recently reported a quarter that I thought was pretty good, but I guess it committed the sin of not raising its guidance to those communities like or dislike, whatever. And the stock has been spanked. At this much reduced share price, would you consider starting a position in Arista Networks? Thank you.
Thank you for the question. They're out of California. They're cloud networking. Do you think it was forecast that took the stock down?
Well, I think it was sort of the commentary they gave on their conference call talking about supply chain bottlenecks. So, this is, in some sense, a company with a first-class problem, demand vastly outstripping their ability to meet it. So recall, this is a pretty large supplier of gear, routers and switches and other hardware, and to some degree software, to the hyperscalers, to campuses and enterprises. So very much a part of the big data center build-out that is going on globally and in the United States and in particular. And so they're growing by leaps and bounds. Their earnings per share grew, I think, 35% in the latest quarter. Their sales are growing quite quickly. And yes, as you noted, Elliot, they really just maintained their guidance, which wasn't enough for the market, and it did sell off pretty sharply, as did its Canadian peer Celestica, with a similar backdrop. So the dynamic here is that their order book is building. Their backlog is strong, and their customers are chomping at the bit, wanting the stuff that they provide so that they can compete in this data center arms race. But they're short of wafers and silicon and optical equipment and memory, as is everybody in this space. And so I think that's the reason why they were unable or lacked the confidence to increase their guidance. Now, having said that, This is a company that has characteristically been very conservative in providing guidance and then usually leaps over the low bar. So they're probably playing the same playbook again. So we've owned this for many, many years, and we continue to hold it in our momentum portfolio. So no concerns with the name. And if you don't own it, the pullback is probably a good entry point.
Let's move on to Henry then. Henry is on the line in Toronto with a question. Henry, go ahead.
Good day. My question is about Novo Nordisk, symbol NVO on the New York Stock Exchange. It's got a very good drug pipeline, and to me it looks like the chart has bottomed out. What do you think? Thank you.
What do you look for to determine if a stock has bottomed out? A lot of these pharmacare stocks have been not doing great. What do you look to try and determine if it has bottomed out?
So I think what you're referring to, Merle, is technical analysis. So our process is sort of multifaceted at First Avenue Investment Counsel. We do deep fundamental research. We do look at charts, that's technical analysis. We also use a machine learning tool, that's quantitative analysis. And we round it all out with sort of macro thematic research to make sure that the idea in the sector are consistent with our sort of higher level expectations for the domestic or global economy. So in this case, the chart has been under pressure. This is a Danish pharmaceutical company. I believe the shares trade as an ADR on the New York Stock Exchange. What they're best known for is the GLP-1 molecule that they sell. This is originally diabetes indication, but now, of course, more broadly being used for weight loss. We don't own the shares, but we're doing a lot of work on its arch rival, which would be Eli Lilly, which has the other big GLP-1 molecule. The concern that has sort of kept us on the sidelines with both of these names is, where are we in the saturation cycle for GLP-1 penetration? And also, what's going to be the price volume dynamic? So recall, these are very expensive prescriptions. They're branded drugs protected by patent. Originally, I think the prescriptions were going for something like $1,000 a month, but Novo Nordisk kicked off a price war and discounted their pill. I think theirs is called Wegovy and Lilly's is called Zepbound or something. They're always such odd and obscure
unusual names, yes.
But in any event, so this one has been deeply discounted. So will they take market share, and what would be the incremental margin impact for them? So right now, we think Lilly has overall the better position in terms of a breadth of branded drugs and patent lives remaining. So it's the one that we're favoring. But as I say, we haven't pulled the trigger on either one of them. These are all very idiosyncratic kind of stocks. And so you really need to have a good understanding of what is going to be the demand for scripts in the market. And in particular, it's muddy here because you've got a price volume dynamic that's really changed a lot in the last year. So we're a bit cautious and tentative on this name in particular, although we like the weight loss space overall, just noting that it is a huge, pardon the pun, addressable market in the United States and really globally.
Okay, let's take a quick break on that note. We'll get back to your phone calls and your emails for Brian Madden, First Avenue Investment Counsel, when we come back. Stay tuned. Welcome back to Market Call. Paul's on the line. He's in Edmonton with a question. Paul, go ahead.
Oh, yes, thanks for taking my call. I bought ARC Resources back in the fall, and my share prices are up by about 15 or 20%. Now, I understand Shell is going to buy ARC out. So should I sell my ARC shares? And if so, should I sell at today's price?
Very good question. We'll turn that over to Brian. What did you think of the deal?
Yeah, I think the deal was, so there's the micro implications for ARC, and then there's a broader read through for natural gas producers and energy in Canada in general. So to the meat of the question, Paul, you're a shareholder. There's a bid from Shell. That's obviously surfaced some value for shareholders. I believe that the shares are trading somewhat at a discount to the price that's been offered by Shell. The deal is all but certain to be completed, so I would hold on to the shares and wait for that gap to close between traded price and the price of the offer. Sometimes people will do that with the view that there might be a competing offer. Don't think that's especially likely in this case because this is quite a sizable transaction. This is, when we looked at it closely last week, it's one of the 10 largest inbound foreign takeovers in Canadian history. So there's just not that many deep-pocketed players with the wherewithal to complete a transaction of this size, or frankly, the appetite to invest in Canadian energy resource. And that is an unfortunate pattern. There has been a broad-based divestiture of Canadian energy resources by foreign owners for much of the last decade. And so this brings me, Marilla, to the broader implications. We think this may be a signal of a turning of the tide, that Canada is once again investable, and we're going to get out of our own way, and we're going to build things like the LNG Canada terminal, which, by the way, I should note Shell is a part owner of on the west coast of British Columbia, and be able to surface value for this abundant resource we have in the ground. So, it's broadly bullish for natural gas producers in Canada, in addition to surfacing value quickly for ARC Resources shareholders. But Paul would counsel you to wait for that gap between today's price and the offer price to close.
Let's move to the next caller then. JC's in North Bay, Ontario. JC, go ahead.
Hi, I'd like to ask Brian about Trican Well Service. I know you've liked it in the past. I'd like to add a little more to my oil and oil service company exposure, but when do you think would be a good time? How long after this conflict has been resolved before maybe it makes a pullback bottom?
Yeah, good question. It's at 676 or 682 here, and it has pulled back a little bit on the last couple of days. So what would you do? Where would you look to put money in?
I mean, frankly, we'd be looking to deploy more dollars right here, right now at today's price. So granted, this stock is up a lot, but that's not a reason not to own it. Companies that are good and growing make higher highs and higher lows. That's exactly what this stock is doing. And if we had a longer context, we would see that this traded at 50 cents down in 2020. But then again, by comparison, it traded at $28 in 2011. So taking the long view is sometimes constructive and informative when you look at a company like this. So what we like about it, they completed the acquisition of Iron Horse Energy Services last summer. Very synergistic, very strategic, and gives them exposure to different basins in the west of Canada. We think that they are the best of breed player in the well service industry, so that's fracking and well completions and coiled tubing, cementing, soup to nuts. They're on the whole gamut, and we think there's going to be a pickup in activity in the Western Canadian Sedimentary Basin. Historically, Trican was more exposed to natural gas production. The acquisition of Iron Horse balances them out a little bit more with oil. But we think they're going to capture those synergies. They're going to benefit from the uptick in activity. And we know that there are more LNG terminals on the drawing board after the long-awaited completion and commissioning of the first one last summer. There's at least 2 or 3 more that are either under construction or under consideration, with, I should note, a federal mandate to expedite their approvals and in some instances perhaps provide catalytic financing through perhaps the Canada Strong Sovereign Wealth Fund or the Canada Growth Fund, and to debottleneck and cut through the muck and mire and all the red tape that Canada has been prolific in producing under the predecessor government for a decade. That's sort of throttled back some of these crucial export and extractive infrastructure and nation-building assets. So we think there's a good opportunity in front of them, not just for the coming quarters, but for many years. So today's a good day to buy, we think.
That was Trican Well. Let's get to an email from Ashley. What are your thoughts on General Motors, GM on the New York Stock Exchange? I haven't looked at some of these motor companies in a while. All of them were taking big write-downs on their pivot away from EV in the U.S. General Motors, 7886 today in New York. Do you own any of these companies?
No, we don't. So we don't own the OEMs, so the big three or the manufacturers, nor the parts suppliers to them. This one, I think this is sort of going to be a bit of a bellwether. I mean, you've got General Motors and Ford and Daimler Chrysler or whatever it's called now. I think it's got a new name. And then you've got Tesla, which basically sucks all the oxygen out of the room. It's got a market cap that's bigger than all of the rest of them combined. However, it should be noted that General Motors has the #2 market share in electric vehicles in the United States with about a 13% market share. Having said that, this is not just strictly speaking an electric vehicle story like, for instance, Tesla, although some would argue that that's about storage and robots and all the other inventions and machinations in the mind of Elon Musk. But electric vehicles, yes, General Motors is throttling back their growth aspirations. I think they're going to produce less of them than they had once aspired to. But overall, it may be the way the future is going, but that future, the can might have been kicked down the road a little bit here. But right here, right now, it's not going to move the needle a great deal. They're still mostly about internal combustion engines. I think electric vehicles are only about 4% of their North American sales. And this is very much a North American sales story. That's where 85% of their production comes from. So although we don't own it, we are not averse to owning it. It does look like the street is expecting them to grow earnings at a compound pace of 13% over the coming 3 years, which is pretty good for a mature industry, especially when you consider the valuation that the shares traded. It trades at 6 times earnings and about 3 times enterprise value to EBITDA, which, by the way, is pretty typical of the other legacy big 3 OEMs. They all trade at a pretty undemanding or outright fire sale multiple, depending what adjective you want to put on it, especially in contrast with Tesla. Chart looks pretty good. And the other thing I would say is this is very much a MAGA Trump stock. This is something that is being explicitly protected by tariffs. Maybe some of those are going to go away, the Supreme Court, et cetera, CUSMA. But you can imagine this is a stock that's going to be very much protected and advantaged by this administration while they remain in office. So cyclical tailwinds here probably and undemanding valuation. So no quarrel with owning it, although we don't ourselves.
Let's take a quick break then. We will come back and have a look at Brian's past picks. That's coming up next. Welcome back. Time to go through past picks from Brian Madden from May of 23rd of last year, so just under a year ago. Constellation Software was a pick, CSU on the TSX at the time, a 48.41.07 recommended, now to 2,440, so 50% return down, total return down as well. They actually did get a bit of a bounce, I think, today from earnings happening. Did you hold on to this?
We did. So needless to say, this one has not worked out in the last 12 months. We have owned it for years and years, so have made boatloads of money on it, but definitely backslid a lot of it in the last 12 months. So it was not, mea culpa, a very timely pick. And so just to sort of explain what has happened and why we continue to own it, this is a vertical market software consolidator. I've in the past described it as sort of like a private equity fund masquerading as a listed software company. And I say that because it's a serial acquirer of small mom and pop vertical market software companies, which are niche, sort of critical, mission critical enterprise resource management tools that are used narrowly in specific industries. So there might be one for a dog kennel, and one for a daycare, one for a golf course, and one for a hairdresser, and one for a church, and so on. So they're sticky, they're mission critical, they're recurring revenues, but the knock is they tend to operate in low organic growth industries. And the reason why the stock has come down so much is the bear has been let out of the cage, and it got out of the cage almost to the day and minute right after we talked about it last year. But the thesis is that AI is going to be very disruptive to these vertical market software companies. Frankly, Marilla, we just don't believe that is the case. The belief is that vibe coding makes traditional software of all types, particularly this type, obsolete. But what that fails to recognize is that software businesses don't start and end with coding. There's also support, patching and fixing bugs and cybersecurity and advances and agile development and all kinds of things that small mom and pop businesses are not apt to do themselves, even if vibe coding lets your 17-year-old do it in their basement. It's not core to their business, and the cost of the licensing is so de minimis relative to the risk of having something go wrong in a mission-critical system that we think the moat is wider than people believe. And so that's why we continue to own the shares here. And to note that at the time we talked about it last year, this stock had been the best performing stock on the TSX, bar none, from the time of its IPO in 2006 through to 2025. I forget how many bagger it was, but it was 20, 30,000. It was crazy. So this is quite a steep sell-off that has taken us by surprise, but it hasn't shaken us in our conviction this is a great company long-term.
I got that 8% bounce today on the earnings just released. Let's get to Lennox.
It's a start.
It's a start. Lennox International was your next pick out of New York. 567.16 at the time to 541.37, so 4% dropped return. Total return down 3%. Have you held on to it? They do climate control. Are they useful in the data centers kind of thing?
No. So this is an HVAC company. So the bigger segment is residential systems. So that's furnaces and air conditioners, now hot water heaters, heat pumps, and things like that. And then there's the building comfort solutions, which is the big, sort of rooftop chillers and evaporators and industrial units. What has prevented this from lifting off, and we do think it will lift off, and we continue to own it in our dividend growers mandate. But what prevented it from really gaining traction last year were there were supply chain problems. There was a regulatory change about the authorized chemical to be used as coolant in air conditioning systems that the U.S. enacted last year, which caused a delay in sort of sell-through. This is a two-step sales channel. So Lennox is the manufacturer. They self-distribute in one part of their business, but they also sell through dealers and wholesalers. And the dealers were sort of like deer in the headlights. They didn't know how the new systems worked, couldn't get parts for them, and weren't sure how the rebates and stuff would come from the federal government. So there was a bit of glut of inventory in the channel. That has started to clear. We saw that very, very, very convincingly when they reported their first quarter results last week. Stock has spiked materially on that news, and we see a continued good growth prospect for a return to their historic cadence of high single-digit, low double-digit earnings growth with commensurate dividend increases. And the share is now trading at an undemanding valuation. And remember, Marilla, this is a company, there are not that many, that is secularly advantaged by climate change. There's far more that are at risk from climate change. This is a company poised to capitalize on more and larger areas of the United States and the world being hotter and staying hotter for longer, needing bigger and better cooling solutions.
Let's get to your third pick. Bank of Montreal last year on the TSX was 142.67 to 11.44 today. So 48% upside, 53% total return. Here's your redemption. Obviously, it's done really, really well, and I imagine you've held on to it.
Yes, we have. So, this is sort of the vagaries of portfolio management, and I guess why we don't build 3 stock portfolios. You can look like a hero one day and a fool the next, but yes, fortunately, redemption in this one. This is a company we also have owned for a long time. In our dividend growers mandate, it's done really well fundamentally, and it's also benefited, as all the Canadian banks have, from a multiple re-rating. And the U.S. banks, too, I should add, have re-rated higher. And I think maybe that is partly because they're managing credit better. We're starting to see bad credit show up in the non-prime, subprime operators like GoEasy, for instance, whereas the Canadian banks are running pretty squeaky clean credit portfolios for the most part. Bank of Montreal also doing very well in the United States, doing well in their capital markets and wealth management business, as all the banks are. So we've continued to own this one. And, with all the Canadian banks, this one included, the basic algorithm is you tend to get between a 3 and a 5% dividend yield. Most of them tend to aspire to and succeed at growing at a high single-digit pace. So you add the two together, and you've got a pretty good line of sight to a low double-digit total shareholder return over a cycle. Obviously, we've seen much better than that in the last year, so that will come and go. But long-term, we expect double-digit returns here.
Let's take a quick break then. We'll get back to your phone calls and your email for Brian Madden in just a moment. Stay tuned. Welcome back. Let's go to John on the line in London. He has a question today for Brian Madden. John, go ahead.
Hello, Brian. MDA Space reported today and beat on revenue, which is not surprising because of the demand for its low Earth orbit satellites. It missed on profit, but the market still likes it. It's up a bit. My question is, should I hold it for 2 to 3 years, or should I add to it and hold it? Thanks very much.
Thank you for the question. MDA Space, considering the backlog they have and the demand for the product, tends to be much more volatile and go sideways a lot more than I thought it would, considering what it has going.
Yeah, I mean, there's been some fits and starts here. So thanks for the question, John. We do own this. We added it to our momentum portfolio last fall. Sort of midway through that drawdown, it was frustrating at first. They lost a contract, they lost another, or there was risk of them losing another contract. But then they started to announce some orders building up. As you noted, they reported this morning. My colleague went through it soup to nuts very diligently, noting the stronger than expected sales and operating profit, or EBITDA. And to our analysis, it looked like when you adjusted for sort of unusual items or non-cash things, their earnings were better than street expectations. They were a bit reticent to increase their guidance, though, and so it's been trading in a wide range pre-open and today, but net looks like it's moving higher. We like the business. The space economy is big and growing secularly. They're a leader in low Earth orbit satellites. They cranked up their production run rate meaningfully last year. Some product innovation. We heard the CEO was on this channel earlier in the day talking about one of their new product launches. There's some concern about the deal with Global Star. Doesn't look like they're going to have to write down that contract. Looks like the deliveries are still going ahead. Their order book is building. And increasingly, they're booking orders outside of the civil market and in the defense market. So we continue to own this, like it, own it at a meaningful weight in our momentum portfolio. So yes, absolutely, by all means, would counsel you to continue holding it.
Let's get to the next caller. Rob down the line in Calgary. Go ahead, Rob.
Hi, thanks for taking my call. I've been watching Exchange Income Corp, and I'm thinking about legging in. Can I get Brian's opinion on this stock and if he thinks it's a buy at the current levels? Thanks again, and have a good afternoon.
Thank you for the question. 105 is where Exchange Income Corp is. Have you been watching Exchange Income? Have you ever dipped into it?
Yes, I've owned it years ago in a prior role. We don't own it in either of our two mandates now, but we've been looking at it more closely. It's obviously done extremely well in the last year. And so why is that? I mean, the name is not particularly descriptive
tell you what they
of
do.
what it
Yes.
does. So, and I don't assume for an instant that this is a household name. So as remember earlier, I described Constellation Software Company as like a private equity fund specialized in software, masquerading as a software company. This is sort of like an industrial private equity company, or what in another era we might have called a conglomerate. And really it's acquiring small and mid-sized businesses in two different streams. One is transportation, aviation in particular, and the other is industrial products, building materials. So what is, I think, changed people's outlook for this company is the change in federal government last year. So starting with the transportation segment, they own a couple of regional airline carriers that serve remote northern regions of the country. And there is a lot of money is going to be going into the Canadian Arctic.
Arctic security, Arctic surveillance.
Absolutely. Yeah. So this is how you get there, and this is how you get stuff there. So those businesses are positioned to be advantaged by that. And there's also a possibility that some of these businesses, the transportation businesses, may get add-on business doing repair, maintenance, and operations service as we get defense spend in these northern regions where they have incumbency and expertise in operating in those climates. Then the other side of the business is the industrial business. This is about a dozen or so collection of businesses that they have acquired from, generally speaking, private owners over time in windows and framing and sort of industrial products that are pretty defensible, but again, ties into this Build Canada theme and this goal of sort of stimulating investment in infrastructure. these are companies that are going to be selling into those projects, so they should also be advantaged, and that's why the shares have re-rated higher. It's historically expensive, but in light of a significantly expanded growth opportunity in front of it, we think it's defensible, and it's probably not a bad time to be thinking about legging into it, although we don't currently own it ourselves. I should also mention it pays a good dividend and increases it periodically.
Okay, let's take a quick break on that note. We'll be back with Brian Madden in just a moment. Stay tuned. Welcome back. We have an email from Kevin. He says, can Brian give me his opinion on Home Depot? It's fallen off, and does he think it will rebound? Where do you put Home Depot? Is it a staples, or is it, where would you put that category? Just retail?
Definitely not staples. It's solidly in the consumer discretionary category, and that's why it's fallen off. So I think, if you take nothing away from my response, Kevin, understand this is a company that's very interest rate sensitive. It's very tied to the housing market. Obviously, there's $50 trillion worth of housing stock in the United States, which ages and depreciates, inexorably and predictably, requiring reno and repair. But people defer renovations because they're often funded with loans, and interest rates spiked sharply higher with the breakout of the war. And interest rates didn't go down as fast as people were hoping they would last year. And so this is a company that really was advantaged by COVID as people were nesting and cocooning and building backyard hot tubs and fences and patios and so on. So it pulled a lot of demand forward. They had tough comps. We thought that the earnings recovery would start in earnest last year. It's been deferred, but not aborted. We also like what they're doing with some of the acquisitions, SRS, Restoration, and another one. So we expect this company to get back to its historic cadence of growth and like the undemanding multiple it's trading at today.
Okay, let's get to the next caller then. Frank's on the line. He's in Toronto. Frank, go ahead.
Hi, Marilla. Hi, Brian. This question is regarding Bank of America or Citigroup. Which one Brian prefers, one over the other? And what does he think of this U.S. banking sector as a whole? Those are my questions. Thanks very much.
Do you have a favorite between the two?
So I'm going to go with the third choice,
okay,
Frank, but I will, I don't want to totally deflect the question. Of the two, we would prefer Bank of America, but those would both be distant second and thirds to JP Morgan, which is, in our view, the best bank in the world, not just the United States, but the best bank in the world. Overall, do we like U.S. banks? Yes, we like Canadian banks better because it's a tighter oligopoly in a less competitive space, and accordingly, the returns on equity are higher. But within U.S. banks, we like the money center banks because banking is technology and scale advantage, and the money center banks have that over the regionals or the community banks, and none has it more so than JP Morgan. So that would be the name that we would go to, and in fact do own in both our momentum and our dividend growers mandates.
Okay, let's get to our caller here, who could be our last one. Harmon's on the line in Nanaimo, BC. Harmon, go ahead.
Hi, Brian. Thanks for taking my call, Marilla. Great job, by the way. Brian, I called in early 2025 and asked you about TD Bank, and that turned out to be bang on. Just wondering what your outlook is on the Canadian banks in general. They've had such an amazing run-up here, trading at all-time highs, PE-wise, and in particular, I'm wondering about Scotiabank. That's the only one with a dividend yield now over 4%. And what's your outlook? Should we wait? Should we expose new money to the banking sector, or off?
Okay, thank you for the question.
Thanks. Thank you.
Scotiabank's trying to redo itself a little bit as well.
It is, yeah. So new leadership, unusual step of bringing in an outsider, fellow who used to run Finning International, which is a Caterpillar dealer. So that's sort of a radical 90-degree pivot. And so Scotia is walking away from trying to be a big banking presence in LATAM and is now more so aspiring to be a bank of North America, so integrated presence, Mexico, the United States, and Canada. They've historically been underpenetrated in the U.S. We're scratching our head over what they've done with Key Corp. They took a minority stake in it a year plus ago. We're not sure if they want to acquire it outright. If they did, we don't know why they didn't do it right off the hop. So this is not one that we would be buying. We've got 3 others that we prefer in the Canadian bank space.
Okay, let's take a quick break on that note. When we come back, we have new top picks from Brian. Stay tuned for that. Join us tomorrow on Market Call. Darren Sissons on the show, partner and portfolio manager, Campbell Lee and Ross Investment Management. He'll take your questions on global and technology stocks. That's tomorrow. Let's get to some new top picks from Brian Madden. Agnico Eagle is the first one, AEM on the TSX. Clearly, gold has had a run, but this is a company you think is worth investing in today.
Absolutely. And for context, we've owned this since 2022, but we just added to it again in March. So, we don't think it's over. It's Canada's largest gold miner post its 2022 transformational merger with Kirkland Lake Gold. The shares are basically a pure play on gold. Revenues are 99% gold, 1% from silver. And that's in contrast to some of these other miners that are kind of polymetallic. 2026 planned production of about 3.5 million ounces. That's across 10 producing mines in Canada, in Mexico, in Finland, and in Australia. So what we like about it, the 10 mines reduce single mine concentration risk. The jurisdictions they operate in are negligible political risk. The management team has got a very well-deserved reputation for credibility and execution against strategy. They've met their production guidance in 9 of the last 10 years. Beat street estimates for earnings in 29 of the last 30 quarters. And the recent pullback of close to 30% off the March high is a great entry point. And we love the strategic, synergistic, and very prospective acquisitions they did in Finnish Lapland last week, which could, if the properties drill out as we expect, add 10 million ounces to reserves.
Agnico Eagle as your top pick. Let's go to the next pick, McKesson Core on the New York Stock Exchange. This is a distribution company.
Right. So it's the largest distributor of pharmaceutical drugs in the United States. The industry is an oligopoly with the top 3 players having a combined 90% market share. The shares also have pulled off meaningfully since March. Notably, yesterday, as one of their competitors reported weak earnings. We don't think that's endemic to the industry. Needless to say, it's an industry that serves a need, not a want, and it's advantaged secularly by demographics and morbidity in the United States. 25-year history of paying a dividend. The dividend has grown at a compound rate of 14% over the last 5 years, and very high returns on invested capital as they've streamlined the business, with catalysts coming down the pipeline as they've got plans to spin off via IPO their smaller medical surgical unit.
Okay, let's get to your last pick, which is Costco on the NASDAQ, COST. Obviously has done well over the years. Do you have valuation concerns here, Costco?
No, this is a company that is expensive every day I've ever looked at it over 30 years in the business. Nevertheless, it's managed to compound shareholder total return at 17.5% since the IPO in 1986. And so why is that? It's the 3rd largest retailer in the world. It's synonymous with warehouse club stores, pioneer in that space. 925 stores globally, 82 million members, 92% member retention rate. They use procurement clout and supply chain efficiencies to be able to price sharply and yet still earn 11% gross margins, in addition to the recurring membership fees, which they increase periodically. Very narrow assortment allows them to be efficient. They only stock about 4,000 SKUs in the store, and they're still expanding store count in market and expanding into other regions. So there's lots of ways to win. And the real standout is the superior same-store sales performance driven by traffic and basket size. Members really attest to this as being an experiential shopping experience. My wife included, I should add, is a big part of their success.
Okay. Oh, your wife probably drove up profit for them. That's awesome. We'll leave it there. Brian, thanks for joining us.
My pleasure.
And thank you for joining us today on Market Call. We'll see you back here again tomorrow.